Why do inflation expectations affect agricultural commodity prices? Imagine a world where everyone expects prices to go up in the future. That feeling can change how much farmers plant today or how investors buy and sell commodities. When people think inflation will rise, agricultural commodities often become more attractive. They see these goods as a way to protect their money from losing value. This increased demand can push prices higher. Inflation means that the overall prices of goods and services are climbing over time. For farmers, this expectation can mean higher costs for seeds, fertilizers, fuel, and labor. If they believe these costs will increase, they might raise their prices now to cover future expenses. This can reduce the amount they supply or make the minimum price they are willing to accept higher. When many farmers do this, commodity prices tend to go up. Investors also react to inflation expectations. They see agricultural commodities as a hedge against inflation, meaning they buy these goods to keep their money safe from losing value. When investors increase their demand for commodities, prices tend to rise. This is because more people want to buy the same amount of goods, driving up the price. The link between commodity prices and food prices is a bit more complicated. Agricultural commodities are part of what makes up food costs, but the connection is not direct or immediate. Supply chains and processing add layers of complexity, so changes in commodity prices might only slowly influence what consumers pay at the grocery store. Still, if inflation is expected to rise, it can change how much people buy or sell, which in turn affects prices. Interest rates are another piece of the puzzle. When inflation is expected to go up, central banks often raise interest rates to keep inflation in check. Higher interest rates make borrowing more expensive for farmers. This can limit their ability to invest in new equipment or plant more crops, which might reduce supply and push prices higher. Consumer behavior also shifts with inflation expectations. If people think prices will increase soon, they might buy more now or change what they buy. This change in demand can influence commodity prices, especially for food and feed. For those investing in commodities, understanding what people expect about inflation is very important. It can cause prices to become more volatile, creating risks but also opportunities. Investors might buy more agricultural commodities if they believe inflation will rise, aiming to protect their investments. Since inflation expectations influence costs, demand, and borrowing, they are a key economic indicator for commodities. By paying attention to these expectations, investors and producers can better anticipate market movements. All these factors work together to shape supply and demand, making inflation expectations a vital part of understanding commodity markets.